Hello viewers, this is MRP, the market technician. Today I am presenting the Dodgy star. We have seen two types of Dodgy star, the bullish Dodgy star and the bearish Dodgy star. First I discuss the bullish Dodgy star. Bullish Dodgy star pattern appears in a downtrend and warns that the trend will change. It consists of a black candlestick or a red candlestick or a fill candlestick and a doji with a downward gap at the opening. When the doji is in the form of a T, is called bullish dragonfly doji, and in case of an upside down T, it is called bullish gravestone doji. Here all these patterns are included under the name bullish Dodgy star, regardless of the shape of the doji. We know what is bullish Dodgy star is. Now we look the recognition criteria of bullish Dodgy star. First, the market is characterized by prevailing downtrend. Here we see a downtrend. Secondly, on the first day before this doji, a red candlestick is observed. And finally, then we see a doji on the second day that gaps down. Then we see this doji gaps down from this red candlestick. There are also some unbreakable rule. The bullish doji star should star. Some people says that you can't even use the deviant doji. Here we see a deviant doji. That means the open or close are not the equal with a normal or long black candlestick, with a normal or this red candlestick, and this doji must continue with a gapping down. This doji a gap down here. Traders' behavior of this pattern. The market is in a downtrend and a strong red candlestick further confirms it. This red candlestick further confirms this downtrend. The next day opens lower with a gap down. The next day opens lower with a gap down, and the trading in a small range. We see here a small range trading here. The day closes at the opening price, causing the formation of this doji. Bears were in control during the downtrend, but now a change is implied by the appearance of this doji, which shows that the bulls and the bears are in equilibrium. The downward energy is dissipating. Things are not favorable for the continuation of a bear market. Buy or stop loss level in this pattern. The confirmation level is defined as the midpoint of the gap between the doji and the previous candlestick. This is the confirmation level. Prices should cross above this line for confirmation. The stop loss level is defined as the lower of the last two lows following the buy. If prices go down instead of going up and close or mark two consecutive daily low below the stop loss level while no bearish pattern is detected, then the stop loss is triggered. Hope we understand the bullish Dodgy star pattern. Now I explain the bearish Dodgy star. Bearish Dodgy star pattern appears in an uptrend and warns that the trend will change. It consists of a white candlestick and a doji with a gap up at the opening. If the doji is in the form of a T, the pattern is called bearish dragonfly doji. In case of an upside down T, it is called bearish gravestone doji. Here all these patterns are included under the name bearish Dodgy star, regardless of the shape of the doji. Recognition criteria of this pattern. First, the market is characterized by prevailing uptrend. That means we need a uptrend. Here we see the uptrend. Second, on the first day a white candlestick is observed. Before this doji, we need a white or green candlestick. Here this green candlestick. Thirdly, then we see a doji on the second day that gaps up. Doji that gaps up. The pattern requirements and flexibility. The bearish doji should start with a normal or long white or green candlestick. It must continue with a doji gapping up. This doji gapping up. Traders' behavior of this pattern. The market is in an uptrend and a strong white or green candlestick further confirms it. The next day opens higher than a gap up and the trading in a small range. The day closes at the opening price, leading to the formation of a doji. Bulls were in control during the trend, but now a change is implied by the appearance of a doji star, which shows that the bulls and the bears are in equilibrium. The uptrend energy is dissipating. Things are not favorable for the continuation of a bull market. Sell or stop loss level of this pattern. The confirmation level is defined as the midpoint of the gap between the doji and the previous candlestick. Prices should cross below this level for confirmation. The stop loss level is defined as the higher of the last two highs following the bearish signal. If prices go up instead of going down and close or make two consecutive daily highs above the stop loss level while no bearish pattern is detected, then the stop loss is triggered. Hope you understand this pattern. For more videos, subscribe now. Thank you very much.